silver to $50, and silver miners to explode higher. So before we get to $50 silver and big moves for the silver miners, let's just cut to a clip from a recent interview with Mohammed Al-Arian and pay particular attention to the last part of the clip.
You think inflation's peaked out? I mean, that's the other big question that I think's on everybody's mind right now. You've seen some things seem to get marginally better, whether it's autos, used or new, maybe on the lumber side and things like that. But then, last week, and I was out in Seattle, Amazon adding a 5% surcharge now, for example, to third-party sellers.
So mechanically, inflation will have peaked out for now. Why? Because base effects are going to be favorable. However, there is another inflationary impulse in the system. It comes from the very high PPI we're having. It's coming from a very tight labor market. So we cannot declare inflation over. Expect especially core inflation to persist at high levels. We're nowhere near the end of our inflation challenge.
So you think we're still, what are you thinking about? If we're at 8.5%, you think we stay around there? We come down to 7? I mean, all of that's still higher than where you want to be at 2%. I don't know what you think over the next 3 years. Are we living at 4 or 5%? What does it look like to you?
Okay, so short term, we're going to come off the 8.5%, but we're not going to come off much. And we may have another leg up later in the year, especially if the Fed doesn't get its act together and if the Fed doesn't control inflationary expectations. Longer term, we're not going to get back to the Fed's 2% this year or next year. So the Fed's going to have a really difficult choice. And it's only a matter of time until you hear people talking about the Fed having to change its target. So, yeah, we do have an inflation issue. We're not going to get anywhere near.
Now you're raising a tough one. Okay, so what would force them to change their target, and what would that target be?
So what will force them to change that target is the recognition that by being so late, they can't get to that target and that credibility is threatened. They will also worry that by hitting the brakes too hard, they may push this economy not just into a short-term recession, but into a longer-term recession. And they will be very tempted, and lots of people will push them to raise that target from 2 to 3 as a way out. Now, that's not going to be an easy way out, and it's going to be incredibly controversial. But that's what you get when you waited too long to recognize what inflation is and to take action. We should have started QT last year. We didn't, and we're now bearing the consequences of the Fed being so late.
Okay, Mohammed, if you're right and they do that, what happens to gold and what happens to crypto on that day?
They both go higher in a world like that.
So I've shared this chart before. There's a very good correlation over a long period of time between silver and the commodities sector. And at the moment, there has been a disconnect. And commodities, which you'll see in a second, has performed exceptionally well over the last 2 years, and in particular in recent times. And the question is, does silver catch up? And based on this correlation, this chart, we're looking at around $50 silver. Or do we see commodity prices crash back down? Well, I think you guys know where I'm betting on this particular trade. And when you look at the overall commodity producers, their free cash flow. Now, I was banging on about their free cash flow in 2020 and 2021. Well, their free cash flow just keeps getting higher and higher, and that's even with higher energy costs, which should be eating into their free cash flow. But after a period of time of the miners being in trouble and not really running their businesses very well, they've really turned the ship around. And as a fundamental value investor, I like buying companies that are cheap, that produce free cash flow. And I look at this sector and I still see a lot of cheap commodities and a lot of cheap metals. So when we look at silver, yeah, I think we will see silver hit $50. I think it will catch up to the commodity sector. But when we look at the last 2 bull markets in silver, okay, or the most recent bull market in silver anyway, you look at the miners, and the miners outperform the underlying asset, in this case silver, you get that leverage on it. And so, whether you're looking at 03 to 08, you can see a bunch of these miners here and how they performed. And some didn't just go up 10x, some went up 20x and 25x. And then during the 08-11 period, and this is where I really profited in silver, and I've done many videos about my own story and how I use wealth cycles to buy silver during this period of time, sell, and then I happened to go over to the States and buy a whole bunch of properties over there, and basically doing wealth cycles all over again. And now, I'm heavily invested in the miners and producers, but also the mid-cap space and also the exploration space. Now, there's a lot more risk in the exploration space, but there are ways that I've learned over the years to reduce that risk. And I've done some videos on this channel where I've shared how I research and how I value those exploration stocks, and to help you guys avoid those mistakes that a lot of people make, and just to reduce the risk in that exploration space. So when we look at how the metals performed in 2021, lithium, there's a massive boom in lithium, and I do have a couple of lithium positions, and they have done exceptionally well. They have pulled back a bit from their all-time highs. I didn't sell, didn't take any profits off the table, because I think lithium is a longer-term play because of the electrification of the economy that's happening, and I think will happen. You guys know my position on all that. This is a topic, the science and the economics behind this. I've looked into it, and look, they're leading us down the abyss, but you know what? I'm going to profit on the way down the abyss. So lithium, cobalt is another one that's done exceptionally well for me. Nickel, funny enough, I don't hold nickel at the moment. I sold nickel in that the first day that nickel shot up last month. I sold because I was, I sell when people are greedy, and I buy when people are fearful. And so I sold. That wasn't sustainable. Zinc's done well, copper's done well for me over the last 2021. The ones that haven't performed well, and this has frustrated many of you guys, is gold and silver. In particular, silver. Silver did not have a good year in 2021, but it had an exceptional year in 2020. It hit a bottom of $12. I think it just touched under $12. It was like $11.90 whatever, and it touched $30. In August? I think it was August 2020. Feel free to fact check me there, guys. But that is a big run in 2020, and so it silver and gold performed exceptionally well in 2020. It's had an off year in 2021, but when we look at the first quarter of this year, silver's up 7.5%, gold up 6.7%. So gold and silver's turning around. Big movers have been obviously still commodities, and we looked at that chart earlier. There's this disconnect between silver and commodities at the moment, and I believe silver's going to catch up. But crude and the whole energy sector has been exceptionally well. And once again, I've shared on this channel over the last 6 months or so about my investments in coal, and the massive returns I've had in coal. That's really been my best performing asset since late 2020. All right, so you heard from Mohammed Al-Arian about inflation. I agree with him. It's not going away. We're going to have elevated, or CPI, sorry. We need to talk honest. Inflation is the expansion of the currency supply. CPI is just a measure of prices. They're two different things. I've done a video on inflation explained using the Austrian economic definition. So, go find that if you want to understand what I'm talking about. There is a difference. You can have inflation and prices falling. I'm not going to go into that in this video, but go watch that video and you'll see. But we've got CPI. We're going to have a CPI problem moving forward. And I've said this, I think we're in an inflationary decade ahead, and that's for a range of reasons. from the expansion of the currency supply to deglobalization now. So everyone argued that globalization was deflationary. Well, that's peaked. We're heading in the other direction. So if globalization was inflationary, deglobalization therefore has to be inflationary. We're seeing conflicts. We're going to have less supply, and I think we are going to go into a recession. So we're going to continue, even if the currency supply shrinks. I believe we'll see the supply of goods and services shrink even faster, which will keep CPI elevated. And you can see here, Europe has got a problem. This is the producer price index. Wow. Germany's wholesale price. I'm not even going to elaborate on this. You guys can just look at this and see what the chart's saying. So Europe's got some big issues. And from an energy point of view, we've touched on energy and oil. And in the US, 8.5%, the government numbers, the BLS, or the BS, we should say, just like in Australia, the ABS, the ABS, emphasise that BS part. But, shadow stats, 17% is if we measure apples with apples back to, the late 70s, then we're looking at 17% CPI. And Australia, we do our CPI numbers quarterly. We're changing that to monthly to be in line with the US and other countries. And our CPI numbers come out later this week. And, well, they're expected to be between 4 and 4.5%. But, when we look at the NAB business survey, the labour costs, prices and purchase costs are going up tremendously. And, Australians, we just think we're the lucky country. House prices never crashed during the GFC. We hadn't had a recession since 91 until, the and the lockdowns, all that sort of thing. So we think we're the lucky country. In fact, I argued that people, working age people under the age of 50, haven't experienced a recession in their life until 2020. And then we saw a huge government intervention come in. So, we've got an inflation problem. And I've done some videos on this where, yes, I was in the Luke Groman camp where central banks were trapped and they'd only raise rates a little bit and then they'd be forced to do a power pivot. And I've been on that camp for a long time until recently. Until recently, you've got Jim Bianco, you've got others who are like, no, this is now a political issue. And it really is. And I've been involved in politics. My wife's been involved in politics. And we understand that politicians are about getting elected. And when inflation hurts the poor and the middle class the most, who do they get angry at? They get angry at the politicians. And therefore, the politicians point to central banks and say it's their fault. And, people get upset. The majority of the population don't give a stuff if asset prices fall and the rich people become less rich. Now, yes, asset prices will overall hurt everybody, and the middle class own a lot of assets as well, but inflation hurts the poor and the middle class very hard. And so I now believe that, they will raise rates, and they'll raise rates higher than we expect. And Jamie Dimon will not use liquidity now to buy longer-term securities to boost interest income given chances of hits to regulatory capital. There you go. They aren't interested in helping the Fed with QT. So I don't think anyone is, in this generation anyway, seeing what I believe is about to come and hit us. But let's just have a look at bond yields, for example. The Australian government 10-year bond is 3.14. And the 3-year note is 2.71. And that's down from 0.1%. Oh, sorry, up from 0.1%, which was in the middle of 2021. So here in Australia, you can see where yields have gone, which obviously means those bond investors who bought in the last 12 months aren't doing too well. And you got the US 10-year, well, it's pushing 3% now. And the 2-year note, similar to the Aussie 3-year, it's off the floor. It's up at 2.74 now. So it's pretty clear where interest rates are headed. We've seen mortgage rates both in the US with the 30-year fixed, and in Australia, our fixed rates from our banks, as I said previously, you could get 1.99 fixed for 5 years. We don't have the 30-year fixed mortgages in Australia like in the US, but you could get a 5-year at 1.99 6 months ago. Now you're looking at around 5%. And here in Australia, a lot of people knew that these interest rates were only going to be, at these emergency lows for a period of time. And fixed rate mortgages have become much more popular in Australia in the last couple of years, where they've jumped from about 15% to 45% in September last year. And you can see from this chart, but the problem with Australia is we do 1 to 5 year fixed rates. We don't have a 30-year fixed rate like in the US. We got 2 banks in Australia that do a 10-year fixed rate loan, but those rates are they're way up now. Newcastle Permanent 6 months ago, their 10-year was at 3.86, something like that, from memory. Now I don't know what their 10-year. I haven't looked at it, but the problem is a lot of these people locked in at 1.89, 1.99 on 2, 3, 4, and 5 year fixed rates, and this is back in 2020 and then into 2021. Well, next year, a big percentage of them are starting to roll off. They're going to roll off to either whatever the variable rate is or look at refinancing. I saw a client the other day, last week, and they're on a fixed rate at 2.6 whatever, and they said, we're thinking about refixing when that comes off in a couple of months, and what's the fixed rates now? And I said, well, you can get this fixed rate at 3 point whatever, this fixed rate at 4, and the 5-year fixed rate is now pushing 5%. Some banks are over 5%. And they were shocked. They're like, what? No. But the Reserve Bank hasn't raised rates. Well, anyway, I think we're going to see much, much higher interest rates, and therefore asset prices, including housing, is going to come down. And for us Aussies, we only need to look across the ditch to New Zealand. The New Zealand Central Bank has raised their rates from 0.5 to 1.5, so they've raised 1%. And just in the last couple of months, we've already seen property prices falling, and falling a lot faster than I expected. And you can see here in the Wellington area, just in the last 3 months, significant falls in 3 months. I'd be surprised if if this happened over a 12-month period. Usually, if you look at the data, housing crashes, for example, average about 6 years from peak to trough. And it's about 52%, something like that. And so, it doesn't go down in big, fast chunks. It's not like the stock market. It goes down a much, much slower, but over a longer period of time. Don't bring up Japan, anyone? And so I've done some videos about the housing markets, the Aussie housing market, US housing market, and I'm bearish on that. How low can they go? Well, no one knows. Anyone that's given you a figure of 10%, 20%, 40%, 50%, whatever, no one knows. They're just guessing. You remember in 2020, our major banks in Australia said housing was going to go down 32%. And then we had a whole heap of government intervention, and banks were given permission not to repossess anyone's homes and allow people to have mortgage repayment holidays. And, no one needed to sell their house, did they? I think things are going to be a bit different when it comes to rising interest rates. And so, yes, I'm bearish asset prices. I'm bearish bonds. I'm bearish stocks. I'm bearish property. I'm bullish gold and silver. And why? Because it's one thing that's not in a bubble. It's still undervalued. And when we start to get financial chaos, and we're seeing a big change in, there's geopolitical issues and whatnot. We're seeing a change, I believe, in the monetary system. And what do you want to have? Well, in my opinion, for me, gold and silver. That's not financial advice. And, I did this video. This is when you sell silver. Now, many of you commented on this video and said, why would I sell for worthless fiat? I don't think you watched the video. And if you did, you need to rewatch it. Because no one in this video said anything about selling for silver. It is about selling our silver, just like well stocks, just like I did previously, is when everything else crashes and either gold and silver goes up or it maintains its purchasing power versus those other assets, then you sell those for other assets, not for worthless fiat. Who would do that? No one in this video mentioned that. So to give you guys a little sneak peek of my next couple of videos, we're looking at a commodity super cycle. Not just that, what I believe to be a silver super cycle ahead. And it's based on fundamentals, and we're gonna ask the question, should we be trading or should we be investing in this sector? And all you need to have a look at is the actual fundamentals and the size of the market and the size of the supply of the metals needed. And if you're an investor, you buy and you be patient and you wait. And if there's any smash downs, you buy again. That's just the market giving you an opportunity to buy. However, you can be a swing trader and you can trade. If your time horizon is short, maybe you're not an investor, maybe you're a trader. And I'll finish this video with this graphic, a major reserve currency since 1250. And as I said, I think that we're seeing some geopolitical events happening where nations, we've got Israel now, who look like they're decided to reduce their US dollar holdings, their reserves and their treasuries, and actually now accumulate some yuan. Personally, I don't like that. I think we in the West have made some bad decisions in recent times, or for some time now. But I'm not overly joyed in some of the things that are happening and some things that potentially could play out. But I do think that the US dollar as the global reserve currency, the sole global reserve currency, is beginning to end. And for me, people say, well, what other currency do you want to own? And I say none. They're all based on belief. For me, it's gold and it's silver and it's commodities. So that's just my opinion. It's not financial advice. What do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. If you haven't yet subscribed, do so. Hit that notification bell. Take care, everyone, and I'll see you all again on another episode of Finance Uncut.